All right, so the US economy just smashed a couple economic records. Yes! For the worse. All right, so here's what's going on. Inflation is getting so bad in this country that game shows are now offering to pay off people's energy bills as one of their prizes.
It is going to be... It's your energy bill! We're paying your energy bill for 4 months.
Credits to John Oliver for finding that clip. That is one of the funniest and saddest things I've seen this year. But also really interesting is that we've been told the reason inflation is going up is thanks to the cost of gas, food, and energy prices going up thanks to the supply chain problems in China. But now, the government has no choice but to admit we can't blame China anymore, because the reason inflation is heating up is thanks to literally everything else going up in price as well. The shelter index, for example, which is a proxy for the cost of rent, went up 0.7%, which I realize doesn't sound like a lot, but just for context, that is the single biggest monthly increase since the year 1991. Then we have the cost of electricity, which went up 15.8% year over year, the single biggest increase since the year 1981. And then we have the food at home index, which went up 13.5% year over year, the single biggest increase since the year 1979. So we are smashing decade-long records, just maybe not the right ones. And that's all because the CPI, the Consumer Price Index, which is the thing that measures inflation, came out this week at 8.3%. Last month, it was 8.5%, so it looks like inflation is coming down, but not really. Because if we use the Fed's favorite way of measuring inflation, which is the PCE, the personal consumption expenditures, that number is actually up. And remember, the PCE takes out food and gas prices out of that calculation. That's because you don't really need food when there's cake and gas when there are Teslas. No, I'm kidding. The reason that economists take out food and gas prices is because they call them volatile. In other words, they fluctuate in price too much, and they are the two only things that, regardless how much they go up in price by, we are still gonna have to buy food and gas. So by taking those two out, economists argue that it gives them a better perspective of where the core inflation metric is going. But even if we use that metric, the core PCE inflation, that number is still double what economists expected at 0.6%. So on the whole, we're not doing better. Inflation is still going higher. Even though the cost of gas is going down, the cost of everything else is going up. And that's also one of the biggest reasons why the stock market lost a massive 4.3% on Tuesday, and Bitcoin crashed over 11% back down to roughly $20,000. So let me help explain exactly what is going on, because this month is going to be extremely important for interest rates, and that's going to affect every household and every investor. So with that said, let's get right into it. Hi, my name is Andrei Jikh. Hope you're doing well. Come for the finance and stay, because I have something really cool to show you. Check this out. This is a stack of bills that are actually blurred in real life. This is not video editing. This is what this object looks like in real life. Looks like Grand Theft Auto money. Super random, but inflation's going up and I needed the write-off. All right, so here's what's going on. The Federal Reserve is about to get together to decide how much to increase the federal fund rate by. And remember, the federal fund rate is not the cost for us to borrow money as consumers, but the cost for banks to borrow money from each other, which of course will affect us as well. The reason this is important though is it's gonna affect everything from the stock market, real estate, crypto, and everything in between. Now, here's something that's really interesting. On June 16th of this year, the Federal Reserve increased the federal fund rate by 0.75%. That was historic because the last time they did that was in 1994. But when they did it this year, the stock market actually went up 2.5%. So right now, that's what the market is trying to figure out. How is this going to affect it? So let's take a look at the trusty, handy dandy little CME Fed Watch tool, which if you remember, also has this epic countdown. I made it seem way more dramatic than it actually is because it's not that exciting, but what this CME Fed Watch tool shows is that there's a 100% chance that rates will go up. That part is obvious, but it also shows this graph, which is 76% chance that the federal fund rate will fall between 3 and 3.25% come September 21st. It also shows this graph, which is 24%, which is that the odds the Fed will increase between 3.25 and 3.5%. I know that sounds crazy, but here's what all of these numbers mean. Right now, there's a 100% chance that the Fed will increase the rates by at least 0.5%, but there's also the potential to increase by 0.75%, which is what the market wants to see. But there's also the small potential for a 100 basis point increase, or 1%, which has never been done before in the history of the Fed. And if that does end up happening, here's what'll happen to the markets. So first, let me give you some context behind the divide in economists' LE5 style. Because the first side of the argument, people like Papa Powell are saying, let's slowly raise rates so as not to crash the economy so that people don't lose their jobs. The other side of the argument, though, says, no, let's raise rates now because the real interest rate is actually negative, which is weird. Why is our interest rate negative? Isn't it 2.5%? It is, but when you compare it against inflation, the real interest rate is still negative, meaning it still incentivizes people to spend and borrow today if they believe prices are going up tomorrow, especially, and think about it from the perspective of the older generation that have been through the 70s. They have been Paul Volckered. In other words, they have lived through a time when interest rates were over 13% in the 70s and in the early 80s as high as 19%. So to them, when they look at the current federal fund rate of 2.5% or the 6% rate for them, the prime rate, they look at that as cheap. They're like, well, if we're gonna get to the 70s and rates are gonna be 12+%, I would rather borrow and spend now. And remember, borrowing and spending now increases inflation more. We have to at least match the real interest rate to the headline inflation number, which is the CPI, which is that 8.5% number, because that 2.5% that we have right now is just not good enough. And that's also why you see people as part of the older generation, people like this guy, Larry Summers, who used to be the Treasury Secretary, want to see the Fed increase rates by 1% and rip the Band-Aid off now rather than wait until inflation gets worse later. Now, if they do that, here's what I think would happen to the markets. As far as the stock market goes, on the day of the increase, most likely the market would go up, which is weird and counterintuitive because when you think about increasing interest rates, money becomes more expensive to borrow, which means more expensive money for share buybacks and acquisitions. Shouldn't stocks go down? Normally, that tends to be true. But when there's high rates of inflation, investors want to pay less money for a company. PE values get compressed because the time value of money means that investors need to use a higher discount rate when valuing a company. Because again, money today is worth more than it does in the future. But when you have high rates of inflation, you have to take that into consideration so that when inflation comes down, stocks will eventually go up because there will be this uncompression or decompression, right? So that's what happens to the stock market. As far as the real estate market, I think that one's a lot easier to understand. When interest rates go higher, obviously homes become more unaffordable in the short term, but in the long term, their values go down. Now let me show you exactly what the odds of all of this happening are. The CME Fed Watch tool shows this graph. Now it's not actually 24% because it also includes the odds of a 0.75% increase in that bar graph, but it is somewhere in there and lower than a 24% chance. But that is also not where the final interest rate or the terminal interest rate will be, because interest rates will still go up in November, December, and February. Now that you've hopefully understood exactly the two different opinions and approaches to raising the rates, and now that you hopefully understood how those rates affect asset prices, let me help explain where the rates will be at the end of the year and how this will affect investments. Whenever people ask, Andre, how do you feel about today's market? I'm like, let me show you. It's like The Shining in here, wallowing in the pain. Apple, for example, lost $194 billion alone. And it's not just them. 99% of companies lost value. Just take a look at this heat map after the announcement. More red. And you might be saying, but Andre, I'm diversified. Why is my portfolio still getting destroyed? And that's because we may not be as diversified as we need to be. And we need to find a more modern solution to the problem. And sure, any single day does not make the market, but it's also not a buy the dip kind of a problem. Goldman Sachs, for example, released a shocking report last week saying that the classic stock and bond portfolio is not going to be enough to keep investors afloat. Just take a look at this, down 20% this year alone. So forget day trading, forget trying to pick individual stocks because everything is in the red. 99%, remember? Now, right now, Goldman Sachs says the ideal stock allocation has shrunk from 60% down to 45%. And what do they recommend we do with the difference to recover our stolen returns? It is to invest in real assets like art. Now, they say that art can not only protect your purchasing power, but the last time that inflation was this high, art appreciated more than real estate and more than gold at an insane 33% per year. That's why I've been talking about this for months and why I've partnered with Masterworks. Just take a look at their results. After 6 exits, the average net return to their investors was 29%. I can't name a single stock that's returned 29% during COVID and during a bear market. Now, some of you who already signed up saw their exit just a month ago with a 33.1% return. That's also why Masterworks has had to acquire and release more art on the platform to meet demand, which is why there's a wait list. But you can skip it by clicking the link in the description below the video. I've been talking about them for most of the year because I think they'll play a role in the future of investing. So go check them out, and now let's get back to it. So the final interest rate at the end of this crazy rate hike cycle is estimated to be anywhere between 4.25 and 4.5%. And here's how you can think about this. Right now, we know that as it stands, mortgage demand has already fallen 29% and interest rates are already at 6%. And that's when the federal fund rate is only 2.5%, which means that when the federal fund rate reaches 4.5%, that interest rates on a 30-year mortgage could go up over 8%. Now that is a huge rate increase and obviously a very bad sign, especially for real estate, which could be made even worse by some of the older people thinking, I've been through this cycle before. I don't have time to wait for the market to recover. You know what? I'm gonna sell before it gets even worse. And their sell-off could accelerate a 10% correction to a 20% crash really fast. And when it comes to risk assets like NFTs, Ethereum, and Bitcoin, we could forget about those because those are gonna perform even worse. Now, I know all of that sounds terrifying, but that's only because it is. Now, the good thing about all of these rate increase expectations is that is all they are. Expectation. That is the single and most important part about the Fed's job right now. It's to manage your expectation, and sometimes managing your expectation doesn't mean raising rates on you. Sometimes it means showing you charts like these and convincing you to think more about saving your money and spending less money. That's another way to get people to think about the psychology of spending money. That's the single biggest difference between today and what was going on in the 70s when people got Paul Volcker. This guy was their Papa Pal at the time, and he was forced to raise rates on people because back then in the 70s, people were convinced that inflation was not going away. That is not the case today. Most people today are optimistic about inflation going away, especially now that gas prices are going down. Source? Trust me, bro. Just kidding. The reason that I know most people believe inflation is going to go away is thanks to this survey of consumer expectations from the New York Fed, which shows exactly that. And this is a very good thing, and that's what the Fed wants to see. Another reason, though, that the Fed may not raise rates on us is because of something outside of our control. Outside the US economy, right now, the biggest gambit is the Chinese economy, which for some time now has been on the brink of collapse thanks to their real estate market, which is responsible for 30% of their GDP, which is again at risk. People in China are already prepared for the crash, and the CEO of their largest privately owned company has warned people to brace for impact. Now, when most of us read headlines like that, what does it make us think of? The worst possible outcome, right? Sounds terrifying. But that is another way to manage people's expectations without raising rates, because it makes us want to save more money and spend less money, which cools inflation. Now, I hope the Chinese economy does not collapse because that would not help anyone. But if it does, the Fed would not raise rates on us because it wouldn't make sense to, which is why right now there's a delicate ballet between reality and expectation. This video is a lot more complicated than my normal videos, but hopefully at least some of that made sense. As always, have a wonderful rest of your day. Smash the like button, subscribe if you haven't already. Don't forget to grab up to $250 worth of free Bitcoin right here. Put it offline, grab the money while it's still there, grab your free stocks, links are down below, and then go track them automatically with a spreadsheet link down below in my Patreon. Love you. Thank you so much for watching. I'll see you back here on Monday, Friday, sometimes a Wednesday. I'll see you soon. Bye-bye.